What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we are looking at the fact that bullion banks have been dumping their shorts. They've been covering their shorts like crazy and really reducing their net short exposure to gold. This is a very bullish sign, as for months now, they've been loading up, doubling down, and continuing to increase on net the number of shorts that they've had, which has been one of the main drivers that has been pushing gold down. So the fact that they're now reversing is a fantastic sign and shows that we could be near or at the bottom where gold really starts to turn around here. Ready? Let's dive in. Here's something probably everybody has experienced. You buy a stock thinking that it's going to go up, and it doesn't go up. In fact, it goes down. Well, you're still very bullish on the stock. You think it's going to go up, so you double down. You buy more of it, knowing that if you buy more at a lower price, now it only has to go up a smaller amount for you to, number one, break even, and then number two, start making larger profits. But then again, it still doesn't do what you thought it was going to do. It goes down even more, so you buy even more because you're still very confident in the eventual direction that it's going to go. And so you buy more, ultimately knowing you're, again, reducing your overall average cost, and you now need an even lower price for it to hit before you break even and start to profit. And all the while, since your actual position size is increasing, you know that once it does start moving your direction, your profits could be even larger. That is exactly what the bullion banks have been doing for months now with gold, except the opposite. They haven't been buying it, they've been shorting it. Now, we all know back in March of 2020, when everything went crazy from the coronavirus and all the illiquidity events and the crazy things happening in financial markets, while the Federal Reserve and other central banks tried to get all these programs rolled out to ease the liquidity concerns, bullion banks almost blew up. And in fact, a couple of them did, and they had to shut down their operations. And desks like the gold trading desk at HSBC lost $200 million in one day, which is usually how much they make on average in about a year. So suffice it to say, they were caught with their pants down. They were exposed net short, and the price really started to rally a lot quicker than they were expecting that it would. If you're not familiar with what shorting is, it's essentially selling something you don't own yet. Let's say that you go online to Craigslist or eBay or something and you sell an old iPhone even though you don't have one, expecting that over the next couple of days, the prices of that exact same iPhone model are going to drop. So you sell an old iPhone for $500. A couple of weeks later, the new one comes out. You still haven't delivered it. Let's just say people would be okay with you waiting a couple of weeks to deliver it. And the new iPhone comes out, the old one's dropped by $100. So then you go buy the old iPhone from somebody else for $400 and then deliver it to whoever you sold it to a couple of weeks ago for $500. You made a quick profit. You sold it first, you bought it back later to deliver. That's exactly what shorting is, and that's what these bullion banks had been doing with gold. They'd been loading up on these short contracts, expecting the price would drop, they'd be able to buy the gold back later for a lower price and close out their positions. That did not happen last year. In fact, the gold price exploded and peaked in August of 2020. Now, for almost a year now, I've been watching the weekly reports come out on the net short positions of the bullion banks, these gold trading desks, to see if they had been closing out their shorts. And they hadn't been. And I knew at some point they would have to, right? If you're in the position where you're buying a stock every time it goes down, you're going to start selling it once it goes up, because ultimately you've got a larger position than you wanted originally. And now you can start taking profits, and you've got larger profits now. And so you're going to start liquidating it once the price goes up. Similarly, all these bullion banks on net were so short that at some point they're going to start to cover those shorts, which means they're going to have to start buying gold. And I know this is all paper contracts, this is all futures, very little of this is actually delivered, but for the sake of this conversation, it actually doesn't matter. So I've been watching this very closely pretty much every week when the data comes out, knowing that at some point bullion banks are going to have to start closing out, covering their shorts and buying gold. And for a long time they haven't been, and it's taken a lot longer than I thought it would take. And every time I thought that they were at their limit, they kept on increasing their positions. Now, part of the problem with a position this large, with how large their net shorts were, is that if you want to go in and close out your shorts to cover, you have to go in and buy gold. That means you have to go buy it from somebody else who's selling it. And if there's not a lot of supply being put onto the market, not a lot of people are selling, then by the very fact of you buying, so much, you're actually going to drive the price up and make the rest of your positions worse. Just like you, if you had built up such a large position, let's say it was a penny stock that kept on going down, you bought more and more and more and more. If you wanted to start selling that and closing that out, then you might have enough shares to where if you start selling it to get rid of your position, it would start driving the share prices down. It's the exact same situation the bullion banks were in. They had to wait until the market was at a place that there were enough other players in the market selling gold that they could buy so that they didn't drive the price of gold up while they were closing out their shorts. And we've just recently entered a dynamic where that has been possible, mostly because rates have been rising so steeply and so quickly. The managed money category, which is mainly hedge funds, has been dumping gold like crazy, which means that they're offering the supply to the bullion banks who want to buy without having to drive the price up. So because of this, over the last week or two, we've been able to see bullion banks have reversed course. They are now covering their shorts, which is a fantastic sign. This is kind of one of the big turnaround signs that I've been waiting for personally to know when this was going to stop, because before this point, they've been continually increasing their shorts, which is selling pressure. Now, bullion banks, unless they reverse course, have turned into net buyers. This is fantastic. Now you might ask, why couldn't they just turn around again and start selling and shorting again? They absolutely could. But number one, the gold price has been falling for the last 6 to 7 months, which means that for the majority of their positions, they're probably profitable. So they're going to be trying to get out because they know they're overexposed. Even though they've been closing and covering their shorts by buying gold aggressively, they're still historically way net short, like way over shorted here. So they have a massive amount of exposure that they've been waiting for an opportunity to close out. So the likelihood that they'll continue to buy, in my opinion, in order to cover and get back to a more of a neutral position is a lot higher, in my opinion. Second, you might be asking, well, if managed money, if category, the hedge funds, if they're selling all the supply, why is that bullish? Well, look at how much they've sold. On net, they're almost neutral now, which means that the capacity for them to buy is huge. They're not maxed out. They've got a huge capacity to turn around and start buying again. And this is important because this category of gold traders is usually a lot more dynamic with the market. When the market is in an upward momentum, they're going to be buying. When the market is downward trend, they're going to be selling. And so the fact that they've reduced almost all of their net longs, as a category, they're almost neutral right now, means that there's a lot of firepower right now in order for them to start buying if it looks like gold is turning around here. And the last kicker is rates. Rates is going to, obviously, this is going to be the biggest, especially short-term driver of the price of gold. If you can get paid interest on your dollars, then financially that's better than you getting paid no interest on your dollars, right? So if you hold a treasury, that's you getting paid interest on your dollars. If you hold gold, you're not getting paid interest on your dollars. But if there's inflation, then you need the interest rate you're getting paid on your dollars to exceed inflation. Otherwise, you're losing purchasing power. So if inflation exceeds the interest rate you're getting paid on your dollars, it's actually better to hold gold in that case, because at least you're not losing purchasing power, you're maintaining it. So when real interest rates go up, that is at least short-term negative for gold, because investors can go put their money in something that's paying them interest. Gold doesn't pay you interest. However, there's a cap on this because the entire economy is so over-leveraged, both corporate America and the government, that if rates get too high, you start to see defaults show up. And that's the last thing they want to happen. And so there's a lid on how high interest rates can go, and we might be there already. So interest rates have been going up because inflation expectations have been going up. But if they put a lid on interest rates and start buying bonds with printed money in order to keep yields suppressed, then that is rocket fuel for gold, because that means inflation expectations are still going up, but that means that your dollars won't pay you a real interest rate. You'll be losing purchasing power in real terms if you invest your money in bonds. And so at that point then, gold becomes the more attractive option. So that's what I'm looking at right now, and that's why it looks very, very positive for gold right here. Ultimately, of course, we could still have some downside here, but with how bearish sentiment is right now, with the bullish momentum now that bullion banks, which are arguably some of the largest players out there in the markets, if not the largest in the markets right now, the fact that they've turned around and they have started very, very aggressively covering their shorts and buying gold looks to me very bullish, and I'm very excited about what we could see in gold, the turnaround here very soon. If you're looking for a tax-free way to invest in gold, you can do it in your IRA. I use iTrustCapital. I really like them. I've been using them for a while now. It's the easiest, fantastic user interface, cheapest way to have a self-directed IRA, and they hold your gold. They also do silver and Bitcoin and other cryptocurrencies as well. And so if you're looking for a way to invest in gold or silver or Bitcoin tax-free, check out iTrustCapital. You'll get 1 month free if you use my link in the description below. As always, I really appreciate you guys. Have a good day.